If you think Canada's housing market is driven only by Canada, you're missing the bigger force, because in reality, a lot of what happens here starts in the United States and then spreads north. So the real question is, who gets hit first? The US housing market or Canada's? Welcome back to Canadian Wealth Lab. Today, we're breaking down how US interest rates set by the Federal Reserve can quietly shape Canada's housing market. Even before Canada fully reacts, the US economy is the largest in the world. So when the Federal Reserve raises interest rates, global financial conditions tighten quickly. Borrowing becomes more expensive. Mortgage rates rise, lending slows, and economic activity cools as credit tightens. Higher US rates also pull global capital into American bonds. Investors chase safety and yield, which strengthens the US dollar and reduces liquidity in other markets. And this is where Canada gets affected. Even without a direct move from the Bank of Canada, Canada is tightly connected to the US through trade, banking, and investment flows. So when capital shifts into the US, financial conditions in Canada tighten indirectly, even before domestic policy reacts. Now, here's the key difference. The US housing market reacts first. Higher rates hit affordability quickly. Mortgage demand slows, refinancing drops, and home prices adjust faster. Builders also slow construction when financing becomes expensive. Canada reacts more slowly. Mortgages are longer fixed terms, so higher rates take time to fully show up. The mortgage stress test also delays immediate impact by forcing borrowers to qualify at higher rates up front. So instead of a sharp reaction, Canada builds pressure gradually. But that delay matters, because while the US adjusts quickly, Canada accumulates pressure over time, and the eventual impact can feel more concentrated when it arrives. Another layer is bond markets. US Treasury yields influence global borrowing costs. When they rise, Canadian bond yields often follow indirectly, which can push Canadian mortgage rates higher even without a Bank of Canada move. So Canada is not fully insulated. It is partially priced by global markets. Now here's what most people miss. Housing doesn't react to one rate change. It reacts to the full path of rate changes over time. That's why effects show up later in data, even though the cause started earlier. In Canada, the delay is longer because mortgage renewals spread adjustments across years instead of months. On top of that, Canadian households carry higher debt relative to income compared to the US. That means rate increases hit budgets harder through debt servicing costs. In contrast, many US homeowners locked in very low fixed rates during the pandemic, which cushions existing borrowers. So, the US reacts faster in pricing, while Canada adjusts slower but in layers. Then there's supply. In cities like Toronto and Vancouver, supply is tight. So when demand slows, it doesn't always show up as a crash, but as fewer sales, longer listings, and gradual price softening. Currency adds another layer. Higher US rates strengthen the US dollar, increasing inflation pressure in Canada and limiting how fast the Bank of Canada can ease. When you combine all of this, rates, bonds, currency, debt, and supply, the pattern is clear. The US housing market reacts first because it is faster and more directly priced to rates. Canada reacts second because the system spreads the impact through renewals and delayed exposure. So, in simple terms, the US leads the cycle and Canada follows it. Not because Canada is disconnected, but because it reacts with delay. And that delay is why the connection is often misunderstood. So, when you hear higher for longer US rates, don't see it as just an American housing story, it's a global signal. And for Canada specifically, It often shows up later in affordability pressure, slower housing activity, and mortgage stress as renewals roll through. Because in this cycle, the real question isn't if Canada reacts, it's when.